Hello guys and welcome back to our channel. If you've ever wondered what really happens when the stock market crashes and more importantly, how to survive it, this video is for you because crashes are a part of market history. In 1992, the Indian stock market witnessed one of its worst falls. The Harshad Mehta scam came to light and the Sensex fell from 4,467 to nearly 2,529. That's a fall of more than 40%. It took nearly 4 years for the investors to see the market recover to those highs. Less than a decade later, in 2001, the tech bubble burst. The Sensex fell again from 4,200 levels to 2,594, weighed down by the Ketan Parekh scandal and the global turmoil. This time, recovery took about 3 years. Then came 2008. The global financial crisis that pulled the Sensex down from 21,000 to just 8,000. Over half of the market's value was wiped out. But by 2010, just 2 years later, the market was back to its old peak. And in 2020, as the COVID-19 spread, the Sensex collapsed nearly 40% in a matter of weeks, from 41,000 to 25,981. Yet this time, recovery was the quickest of all. Just 8 months later, the index climbed back to its old highs. Our point here is that crashes can be worse, but the market always recovers. And that's why we're here today, because crashes will keep coming. We can't predict them, we can't prevent them, but we can prepare for them. So in this guide, we'll build your complete crash survival plan, and by the end, you'll know exactly how to face a stock market crash without fear, and maybe even turn it into an opportunity. Part 1. What is a stock market crash? Let's first understand what a crash is. A crash is when stock prices fall fast, usually more than 20% in a short time. It feels sudden, like the ground has been pulled from under your feet. But the truth is, crashes are not alien. They're part of the market's DNA. Think of monsoon floods. Every few years, the rain comes harder than expected. They cause floods in the fields, road breakages, and house leaks. But do farmers quit farming? No. They prepare, rebuild, and keep planting. In the same way, we don't quit investing because of a crash. We prepare for it. Part 2. But why do we panic? Now here's the interesting part. The real danger in a crash is not just falling prices. It's what happens in our mind. When we see red numbers, our brain treats them like a threat. The same part of the brain that reacts to physical danger, like a tiger chasing us, also reacts to losing money. That's why our heart beats faster, palms sweat, and we feel like, I need to do something right now. But acting in panic often means selling at the bottom. And as history tells us, markets always recover. The problem is that many people don't wait long enough to see that recovery. Loss aversion. Imagine holding a stock that's down 40%. Instead of cutting losses, most people cling to it, hoping it'll bounce back. But often, weak companies never recover. By the time investors accept reality, the stock has already sunk further, turning a manageable loss into a permanent wipeout. At the same time, they sell their strong, profitable stock too early, just to get a quick sense of relief. Herd mentality. When the news screams markets are crashing and everyone around you is selling, your instinct is to copy them. But following the crowd usually means selling at the worst time. Overconfidence. Some investors believe that they can predict the bottom. They wait for the perfect price, but history shows us no one consistently gets it right, not even the professionals. Recency bias. When the market is falling, it feels like it'll keep falling further. In 2008, many thought markets would never recover. By 2013, the same markets had hit record highs. Part 3. Lessons from history. Let's look back for a second. The market has crashed many times, and every time it has recovered. After the Great Depression, markets recovered. After wars, recessions, and financial crisis, they recovered. Even after the global pandemic crash of 2020, markets bounced back within months. So while every crash feels like the end of the world, history teaches us one thing. It always feels unique when you're in it, but the pattern is the same. Decline, fear, recovery, growth. This doesn't mean every stock will survive, some don't. But overall, the market, the system, always finds its way up again. Part 4. Step-by-step action plan during a crash. Alright, now let's get to the heart of it. Let's understand what you can do when the market crashes. First rule, don't do anything in panic. Give yourself at least 48 hours before making a big decision, because panic decisions are usually the wrong ones. Think of it like when you are sick. You don't directly take the medicines. You first rest, then go to a doctor, then get the medicines and take them as prescribed. Second, check if you have at least 6 to 12 months of expenses saved in cash or safe assets. If yes, you're safe. You don't need to sell stocks for daily needs. If no, this is where most people go wrong. They're forced to sell at the lowest point. That's like selling your umbrella in the middle of a storm. So, before investing, always build your emergency fund. It's your shield in a crash. Third, if 100% of your money is in stocks, a crash feels like you have lost everything. But if you had some money in safer places, the shock would be smaller. That's why we use asset allocation. Proper allocation of your assets ensures that your portfolio is well balanced between stocks, bonds, and cash. Fourth, do not stop your SIPs. Yeah, stopping your systematic investment during a crash is like refusing to eat during an illness. In fact, this is when your SIPs shine because you're buying more units at a cheaper price. Think of it like buying your favorite product on discount. Same item, lower cost. Crashes give you that chance. And if you're invested in a proper mutual fund, you will see good gains. You can use Share.Market's CRISP tool, which analyzes mutual funds by providing actionable insights on consistency, risk, and investment style of the portfolio. The CRISP scorecard goes beyond basic rankings and shows investors what's really driving a fund's performance and risk. Fifth, during crashes, avoid news as much as you can. News is designed to get your attention, not to help you invest. Instead of reacting to every headline, ask yourself one question: will I need this money in the next 10 years? If not, why panic today? Let the cycle play out. Now we're going to give you a simple framework to remember during a market crash. It's called CRASH. C for calm. Be calm. Don't act impulsively and don't panic sell. R for review. Check your emergency fund and asset allocation. A for adjust. Rebalance your portfolio if needed. S for systemize. Keep your SIPs and stagger new investments. H for horizon. Remember your long-term goals. Stick this on your wall and you'll never forget. Along with what you should do, it's also important to know what you shouldn't do during a market crash. Don't do these 4 things during the crash. Don't check your portfolio every hour. It's like scratching a wound. It only hurts more. Don't borrow your money to invest. Leverage plus crash equals disaster. Don't change short-term money into long-term investments. If you need money soon, don't risk it in the market. Don't abandon your plan. Crashes are temporary, but mistakes made in panic can be permanent. Crashes test our emotions before they test our money. The key is to set up our environment so that the smart choice feels natural. Keeping some cash helps us avoid desperate mistakes. Rebalancing lets us benefit from ups and downs. Clear rules guide us better than overconfidence. And in the end, staying invested for the long run is what turns a crash into an advantage. If you found value in this video, don't forget to hit like and share it with your friends. Subscribe for more such insightful videos. We will see you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.